Ladies and gentlemen, good day and welcome to the Q1 FY23 financial results conference call of Alembic Pharmaceuticals Limited. We have with us from the management Mr. Pranav Amin, Managing Director, Mr. Shaunak Amin, Managing Director, Mr. R.K. Baheti, Director, Finance and CFO, Mr. Mitanshu Shah, Head of Finance, Mr. Jaisal Shah, Head Strategy, and Mr. Ajay Kumar Desai, Senior VP Finance. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. R.K. Baheti. Thank you, and over to you, sir.
Thanks. Good evening, everyone. Thank you for joining our first quarter for 2022-23 quarterly results conference call. I'm sure you would have received the results by now. I know the financial numbers are a bit below your expectations, but during this call we'll try to explain you the results and also the reason why we think the underlying business is robust. So first of all, financials. During the quarter, our total revenue were at 1,262 crores, EBITDA was 9 crores, and net loss was 66 crores. Continuing review of our Aleor R&D cost, which was capitalized earlier, and looking at the conditions in the US generic business, Aleor still is a separate company. The merger process is underway. So Aleor has further written off 115 crore rupees out of its CWIP, out of capitalized R&D to P&L. And so we did it in March 2022 also, and 115 crore we have written off in June 2022. The residual intangible assets in Aleor now is just about 40 crore rupees. Had Aleor followed the previous practice, APL's consolidated profit before tax would have been higher by 115 crore, about 50 odd crore rupees. EBITDA on likewise basis would have been 107 crores. Borrowings. The gross borrowing at consolidated level is 515 crores versus 630 crores in March 2022. The company has 112 crores as cash on hand. As on March 2022, it was 61 crore. Net borrowing as on 30th of June 2022 is 403 crores versus 569 crores as on March 2022. Our net debt equity is very comfortable at 0.08. I will now hand over the discussion to Pranav for his presentation on international business.
Thank you, Mr. Baheti. It was a challenging quarter for the US business, especially when seen in light of a very good preceding quarter. I had mentioned in the last investor call that we had made a switch to a new third-party logistics vendor. Due to this, we had anticipated some supply disruptions, and hence the buyers had pulled in extra inventory to ensure that the quarter was smooth. This led to a slow start to dispatches during the quarter, and the revenue for the quarter was $47 million in the US. We continue to remain focused on the long term of the US business, backed by 15 plus launches every year, and hopefully consolidated market share in our existing products. The near term will remain challenging, but long term we still remain optimistic about the US business. The ex-US formulation business as well as the API business have both come off a very high base of last year, hence the growth was muted. We are confident on both these verticals moving forward and from the next quarter onwards. Our R&D expense is 261 crores. Ex of Aleor's revised charge of R&D, the expense is 146 crores, which is 12% of sales. We filed 7 ANDAs during the quarter, and cumulative ANDA filings remain at 237. We also received 8 approvals in the quarter, including 3 tentative. We launched 5 products in the quarter and plan to launch another 5 to 7 products in the next few months as well. The FDA remediation is ongoing at our F3 injectable facility currently. We have appointed a bunch of consultants, and we are in remediation measures are underway, along with we're in touch with the FDA as well to ensure full compliance. This will take a couple of months, hopefully, and we should have better news for you. The US generics was flat at 367 crores for the quarter. The ex-US generics degrew by 8% to 182 crores for the quarter, whereas the API business degrew by 16% to 233 crores for the quarter. I will now request Shaunak to take you through the India branded business.
Yeah, so good afternoon, everyone. The India business, if I could talk about it, was, I think we had an extremely good quarter. So the top line numbers do have a base reflection of last year's COVID Delta and wave, which causes distortion. But when I look at the numbers, ex-COVID adjusted, I think we see a very strong growth. Even on the veterinary growth, I think we see extremely strong growth with 35% growth over last year. Our overall growth put together was, though the number was flat, like I said, COVID adjusted, we grew at 20%. And if I look at just external numbers, I think the industry showed a negative growth of 2%. Alembic, as is reflected, a parallel growth of negative growth of 3%. But ex of azithromycin, which was a big contributor to last year's sales numbers, the industry grew by -1%, whereas Alembic recorded a growth of +12% as per IMS in the same period. Based on this, I think we're extremely bullish on the India business. Keeping that in mind, I think Q4 onwards, looking at the traction, looking at the portfolio growth, we did start to increase investments in the business, and we did see a significant ramp up in Q1 in terms of investments, and we expect some of these to start playing out in terms of top line numbers going into as early as Q2 and Q3. Other than that, I think the core portfolio of the business continues to do well, and with a strong onset of monsoon in June, July, in July mainly, and continuing into August, we expect the acute portfolio, which is a very strong part of our business, to continue with market-beating growth numbers. I would like to open up the floor for Q&A now.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. We have the first question from the line of D. Kerai from HSBC. Please go ahead.
Hi, thank you for the opportunity. Bharti sir, you explained about Aleor charges. So in the previous quarter, you took around 123 crore, and this quarter 115 crore, and then you mentioned around 40 crore is residual. So say like we have to again charge of this 40 crore. After that, there will be no R&D expenses related to Aleor, or how should we look at that part of the cost?
So second part of your statement is right. 40 crore is what is now residual. The only correction I make in your first part of the statement is previous quarter, that is in March 2022, we charged off 189 crores.
Okay, so 189 in the fourth quarter, 115 crore this quarter, and then we are just left with the 40 crore residual part.
350 crores spent over last 3-4 years on R&D.
Okay. So, sir, anything else like where assessment is ongoing and then we might see similar charge-off, which is right now not part of our operating cost, or we should be just looking at the Allure portfolio?
Now, as far as Alembic Pharma is concerned, in any case, we have been charging off all R&D expenses to P&L since beginning. So we have no accumulation in balance sheet there.
Okay. And just a question on R&D. So even if we adjust for this Allure charge, it still remains notable at around 12% of sales. So how should we look at this cost going ahead? And as we see, like US challenges are far from getting over, are we thinking about reallocating R&D to some other businesses?
So, no, you are right, but okay, I look at percentage of profit as percentage of turnover as just a number because it is dependent on two different numbers. But in absolute terms, we don't plan to increase R&D. The R&D cost, including the Allure, on a current basis is about 700 crore rupees a year, and we'll contain it within that. And we are also looking at rationalizing it to some extent, to the extent it is possible without really affecting the growth of the business in future. So you can say that it will stay between 650 to 700 crore in coming years.
Okay, so 650 to 700 crore kind of R&D spend will continue on absolute basis, and majority will continue for the US market, right?
Yeah, majority is for US market, but now we are extensively using the same setup to do dossier extensive filings for on EU and for the rest of the world markets, regulated markets, but we are only in regulated markets.
Okay, sir. And my last question on India business, how much is acute sales of the total India business?
Ajay, you would have that number ready?
Yeah, it's 118 crores.
118 crores. Okay, sir. Thanks.
118. Yeah.
118, yeah. Okay, thanks. I'll get back in the queue.
Sure, thanks.
Thank you. Our next question from the line of Chirag Dagli from DSP Mutual Fund. Please go ahead.
Yes, sir. Thank you for the opportunity. Sir, I understand there was some upfronting of revenue in the fourth quarter last year, and now that number is low. But if I look at the last 3-4 quarters average, then it seems like the base business is whatever 55 to 60 odd $1 billion. So is that the base, or is the Q1 $47 million odd that we've reported that the new base?
So Pranav had said in the previous calls that $55 million for US is the base, and
Okay,
we still
sir.
remain we remain to that.
Understood. Okay, fair point. And sir, can you help us just broadly understand, as we look into the next two years, how would the scale up of expenses both above EBITDA and below EBITDA just broadly happen?
See, there are few expenses, Chirag, which are beyond our control, and there are few expenses where we can have a significant amount of control. Now, expenses which are under our control, we are doing everything under the sun to contain them, rationalize them, make them more productive, make them more effective. But some of the expenses, and I'll give you an example, particularly in international business context, like freight cost. Now, freight cost, I'm sure you must be talking to multiple pharma companies, has gone up almost across the board. Not only India to US freight cost, but even internal freight cost in US has also gone up multi-time, not in terms of percentage. So that is impacting us, and that's where we don't have much of control. So some expenses we can't predict. Some input costs have gone up because of this crude price being very high in Q1. Solvents and some of the material costs also went up. So these are beyond our control. But operating cost, overheads particularly, we are trying to contain as much as is possible.
So my question was more about what we are capitalizing and what we've already spent so depreciation as well as the OpEx that we are capitalizing as some of these facilities come on stream. What sort of costs will hit the P&L is what I was trying to understand, and how that phasing out.
When these facilities get into commercial production.
Correct. So what is the quantum, sir, both depreciation and OpEx?
So that would be, you can say, first 200 crores about?
So yeah, I mean around 180, 200 crores of cash expenses, and then you will have another 150 crores of depreciation.
This is still left to be taken into the P&L.
Yeah, that's for all the three plants.
Correct. So, sir, is there a way to sort of think about the phasing out of this, of how this will over what period will this hit the P&L?
Actually, that will get capitalized part of the respective assets. So we are not, we'll have to carry an extra depreciation burden, but I'm not so worried about it at this moment. What I'm more worried is how soon we can make the plant operational and start churning revenue out of that. So we are, like Pranav said, we are working proactively with the FDA for resolving the issues of F3. F2, part of the asset is already approved by FDA, and part of it we already started filing, and the inspection is already triggered. Let's see when the FDA visits us.
Understood, sir. So my limited point was that we have 350 crores hitting the PBT. To generate that kind of gross profit, we'd probably have to do 500 crores worth of sales in the US. So is this understanding right that while the sales may take time to scale up, but the expenses will immediately hit on a fully loaded basis and will be upfronted?
No, which is true. Largely what you say is true.
Understood, sir. Okay, sir. Thank you so much.
Thank you. We have the next question from the line of Vaibhav B from Honesty and Integrity. Please go ahead.
Yeah, hi sir. Thanks for providing the opportunity. So I have two questions on the international business, and then I will come back in the queue for the domestic business. So on a US oral solid part of the business, can you give me an idea like what would be the gross margins in that business? I don't want EBITDA margins or what ROC we are making, but there's broad range of gross margin in US or oral solids business.
So we don't give vertical-wise margin breakup, but what is for sure is that the margins have gone down because of the price erosions in US.
Okay. Okay. And in terms of the price erosion that has happened in the US, in US specifically, is it like a different kind of erosion that we are seeing between chronic and acute products, or it is across all the products? Because in some of the cases we hear that the price erosion in chronic is less than acute products. Is it true?
No, actually the US is a generic market, so I think you're seeing erosion across the board. There's too much supply and too many people supplying in the market, especially from India. So price erosion is across the board.
Okay. Got understand. I will come back in the question. That's it.
Thank you. Participants who wish to ask a question may press star and 1 on your touchtone telephone. Participants who wish to ask a question may press star and 1 on your touchtone telephone. We have the next question from the line of Rashmi A from Dolat Capital. Please go ahead.
Yeah, thank you for the opportunity. So one clarification on this 115 crores, how much is that sitting in the other expenses and how much is there that is there in the depreciation part?
So around 100 crores is in other expense and 15 crores is in depreciation.
Okay. And on your US business, this quarter we have reported $48 million, and you are saying that the base business is around $50 to $55 million. So what led to fall of that extra $1 million? Is it because of anything which is one-off, or this is something which will continue in the subsequent quarters only, that this will become the new base?
So, in the last quarter, Q1, I had said that I anticipate that around 50 million, maybe 55 million, depending on the situation, would be our base business. Having said that, the last quarter we did about 70 million in the US. That was due to some one-time buys, as well as we moved our 3PL, we moved our distributor, a third-party logistics provider, this quarter. So that's why the buyers had stocked up a lot more. That's why last quarter the sales were higher, which led to a slower offtake in the start of the quarter for this quarter.
Okay, so you mean to say that from the second quarter, we should come back to our run rate of around $54-55 million?
So it depends. I think seeing how the erosion also goes, in my opinion, will be closer to 50 million, because I'm seeing a lot more erosion in the market than I saw at the end of Q4.
So how much is the price erosion? Is it still in double digits for Alembic?
Yes.
If you could quantify that?
Yeah, I would say it's in double digits. I haven't looked at it because it's a moving figure, so I don't keep looking at it. But I anticipate it will be in low double digits.
Okay, and any new launches which you are guiding for FY23?
So we launched 5 products in Q1. We anticipate to launch 5 to 6 in Q2 as well. And for the year, I think we'll be anywhere between 15 to 18 kind of launches.
Okay. And what kind of growth we will be seeing in the specialty and acute segment in India business? Any guidance if you want to give? And also for this quarter, if you can split between price growth, volume growth, and new launches growth?
So we don't give guidance that way, but what Shaunak has already said, that we are pretty confident about the market beating growth rate, both on specialty and on acute, except of COVID-related products.
Okay. And the last question on gross margins. We were doing around 73-74% gross margin, and I think more or less it was expected that it would remain in that range. But I understand that due to the US price erosion and due to the high input cost, the gross margins have slipped to 70%. But anything which you can let us know that month on month basis, the input cost is getting it's coming off, and from the second quarter we are going to see any improvement from here on, or you feel that this would be at least for the entire year?
Very difficult to say at this moment. It will be dependent on multiple things, input cost as well as the realization which I do. So I'm not putting a number as of now.
Okay, so is it safe to assume that it would more or less remain in this range, only 70-71% for the entire year?
Your own assumption. I'm not giving guidance on this.
Okay, all right. Thank you. That's it from my side.
Thank you. We have the next question from the line of Nikhil Mathur from HDFC Mutual Fund. Please go ahead.
Yeah, sure, sir. I just have one question. The last time I remember, there were some 150 approvals that were in place, and the company had launched 104, 105 products in the US. So the remainder of the products that are yet to be launched, should we assume that there's any economic value left, or I think, given how the situation is there in the US, there's barely any economic value left in those products?
So generally with the market situation, as I said, we'll launch about 15 odd products this year. I think some are awaiting patent expiry, so those we launch as and when the patent expires. Those are tentative approvals. And the rest we will take, some are in the process of launching, and some we may choose not to launch because of either technical issues or because of the market situation.
Okay. And again, on the gross margin front, it's very counterintuitive. If I look at the sales representation of India in the overall mix, it has kind of gone up. So generally, in many other peer companies, the margins in India are usually better than the export markets. So this dynamic is different in Alembic, and hence actually India growth or India higher share leads to some bit of margin dilution.
So I don't know whether I have understood you right, but previous few years, we did extremely well in US, backed by some very good products realization, and our margins in US were much better. Of course, US incurs a much higher percentage of R&D, but otherwise at the gross level margins US were very good. India margins are more or less like consistent, and they remain except for some bit of changes due to those COVID-related disruptions a year and a half back. But otherwise, India margins remains more or less consistent.
So, sir, your US margins are one of the highest in the industry. And I think there's a specific strategy because of which you generate such high US margins at the gross level. Isn't it a big risk for Alembic? I mean, at 68, 69%, whatever 70% gross margin, no other Indian company does this. I think it's a big risk going forward, especially when the pricing outlook is so bleak for the US market.
So, I mean, okay, at the peak level when some of the products were doing very well in US, our margins have also peaked to 75% plus. And at that time, I said that these margins are not really sustainable in long term, and they will come up, and they are coming up. So, but I mean, even if you say our margins are better than industry, I'll take it as compliment.
Right. So, but the past is I mean, all credit to the company for what you guys have been able to deliver in the past. But if I look at 2-3 years out, is my expectation right that there can be more risk than tailwinds to your margin profile?
It's very difficult to say because it's very difficult to predict the market, particularly the US market. I mean, India market, as I said, is more consistent and more predictable, but US is very difficult to predict. So, won't really comment. But we believe that, or not we believe, rather we hope that sooner than later, US also will stabilize at some point of time.
Also, what I think is one thing is the US is the largest market in the world, and it is a market that we cannot not be a part of. It's a great market to be a part of. And I would say that you have to look at it a little bit more in the long term. If you see our last 10-year track record, the profit and the revenue growth has been quite exceptional. I think over almost 30% profit, 25 in terms of top line. So yes, the US does is a little cyclical, but I think it's an interesting business and you cannot not be in it.
Got it, sir. And sir, what is the currency transaction impact? Where would that be sitting in 1Q? Because I don't think any major gains, at least in other income. So how is the currency accounting played out?
So generally, rupee depreciation has been favorable or good for pharma companies. We are also net foreign exchange earner. So generally, it has a positive impact.
Can you quantify that, sir, in this quarter? How much of positive impact is there from currency?
We don't, because a part of it was hedged. I mean, like we said, 30-40% of it we hedge on a regular basis. The balance remains open, but I think we would have got some benefit out of it.
Okay. Thanks a lot, sir.
Thank you. We have the next question from the line of Harith Ahmed from Spark Capital. Please go ahead.
Good evening. Thanks for taking my question. First one is on the F3 facility. You mentioned that the remediation activities there are underway. So, in your assessment, will this facility require a reinspection before it gets cleared by the FDA? And regarding the F2 and F4 facilities, do you have any expectations around inspection timelines for these two new facilities?
Okay, so F3, I believe it would require an inspection, but let's see how it goes in terms of the FDA's, how they accept all the results, and we've been updating them on a monthly basis, but I believe it will require a re-inspection. As regards F2, the oral solid part is already approved by the FDA, so there's no issue there. The injectable bit, we've filed some products, so we should trigger a filing as and when the FDA increases their audits, which they already have. I think we should have them visiting us for an audit as well. F4 also we have filed. I think, however, in the priority list of FDA, this will be a little later, so I don't think that will happen this year.
Okay, that's helpful. My second question is on margins, and I'm looking at margins adjusted for the one-off R&D at Aleor. That's around 100 crores, which is above EBITDA. Still, the margins are at around 10%, slightly below 10%, while we were at a closer to 20% number through most of last year. So how should we think of the recovery in margins from this level, and maybe some color on how the recovery would play out over the next few quarters?
So margins would stay under some pressure till the realization from US improve, while we are doing everything possible under our control to do some cost rationalization. They would have only a smaller influence on margin. I think we would bank on US doing better for further improved margins.
But sir, while we are expecting a recovery in the US in the coming quarters, over the next 3 to 4 quarters, we'll also see the additional costs which are getting capitalized now. So that would also mean further pressure on margins from the current levels, right? So
I said once the new facilities becomes operational, and as an earlier participant also mentioned, initially the revenue will be lower, but expense will be higher, there will be a pressure on margin. So like any growth, you need to sustain a higher cost in the transitional period, but that's how you grow the business.
Okay. Last one, if I may. You comment on the intangibles write-off at Aleor. You mentioned that the write-off was done to reflect the current market conditions. So this thinking about the adverse market conditions pertaining to the US generic market, does this also imply that we will have a rethink on our future capex as well as R&D spends for the US market? Because the way when I look at the numbers, our normal R&D spend continues to be at around that 150 crore level on a quarterly basis. So now that you're seeing the market conditions turn adverse, will we have a rethink on probably lowering the spend to reflect the more challenging environment there?
Yes, you're absolutely right. I think the way we're approaching the US is two things. One, on the capex side, all these new plants we did were essentially new capability that we did. So I don't anticipate any new capex, large capex, or any new facilities coming up for the US moving forward. At the most, we may have some incremental capex or maintenance capex. We may increase some API capacity, but on the formulation side, we will not do any capex or any new facilities. As regards the R&D, yes, we're constantly evaluating that as well. How do we rationalize the R&D spend as well moving forward? Because the returns in the US are more. We'll rationalize it by either looking at other territories or in terms of other verticals. Now, this R&D that you see is not just OSD, but it includes injectables and the other verticals as well. And this will help the new plants get up to steam faster as well.
Okay. That's all from my side. Thanks again for the opportunity.
Thank you.
Thank you. We have the next question from the line of Bharat Celly from Equirus Securities. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. So I just wanted to understand on product called Pharmaceuticals. So I believe we have already launched that. So just wanted to know how you are seeing the traction in that product, and whether we have seen any adverse pricing in that drug. So anything you can comment on the overall outlook of this drug you have launched?
Yeah, it's a good product. We've launched it. We've picked up some share as well in that product. I think it's got a little lesser competition. So let's wait and see how it goes. It is from a CMO, so we're slowly, gradually picking up more share as we have more confidence in the supply chain.
And what sort of market share we will be reaching in this product at this point of time?
It depends, but I think we must be around 15% or so. I think it's about 15% or so.
And so we are referring that we will be having around $50 million base in the US market. So that guidance is including this drug?
Yeah. So what's happening is the base business, it started including these new products because some old ones has gone back down, and this is there. So in that, I'm including this as well.
So actually, I'm failing to understand one thing, because this drug is almost like $300 million drug or upward of that as per the IMS, and there is only it is a two generic player market, and yet we our base number in that case X of this drug might be much lower. So I don't know exactly what exactly is happening in that front. Whether formoterol is relatively still a sizable chunk for us or not. It is very difficult to get clarity on that.
So two things. One is we don't give product-wise breakup, but you have to realize that what the reported figure is, it could be gross sales versus what everyone looks at as a net sales. So you have to see that differentiation, which is not necessarily captured all the time in IMS, and that's why you're feeling that it's a much larger product than it is.
And according to you, what will be the net sales of that drug, if you could provide?
So I don't, as I said, we don't give product-wise guidance on the sales of a product.
So I was referring to the overall market. How big?
As the industry, I would say net sales will be about 20 to 40% or so, 20 to 30% depending.
20 to 30% of $300 million.
Of whatever the gross sales are. I'm giving a range for an industry-wide product.
Okay. Sure. Thank you, sir.
Thank you. We have the next question from the line of Akshata Rain from Green Portfolio. Please go ahead. Ms. Akshata, can you hear us?
Hello? Yeah.
Yes.
Thanks for the opportunity. My first question is related to CWIP, as there is CWIP of 2200 plus CR as on 31st March 22. Can you please share what it pertains to and when are they scheduled?
Can you repeat the question? We didn't get you.
Yeah, my question was the CWIP is of 2200 CR as on 1st March 22. Can you please what it pertains to and when are the projects scheduled?
We were discussing, Akshita, no? We have these three facilities which we have built. F3 was for injectables, F2 is onco oral solid as well as onco injectable, and F4 for new formulation facility. So all of these are CWIP because none of them has gone to commercial production yet.
Okay. Also, can you please share ALO's EBITDA percent and Alembic's EBITDA percent without ALO?
Just there in the results itself, we have about some participants also. It has fallen, but it's about 10% or little less than 10% EBITDA without any impact.
Okay. So this might be naive of me, but could you please share why, like in the table of Q4 FY22, it doesn't show any change in revenue? I understand that AIR was a subsidiary with 60% stake, so sales should have been added line by line, right?
So that company in March itself we had acquired the balance 40% and now it's a 100% subsidiary. Currently, we are in process of merging AIR with Alembic Pharma, and the matter is with the Honorable NCLT Ahmedabad.
Oh. Thank you.
Okay.
Thank you. Participants who wish to ask a question may press star and one.
Pick the last one. Later.
We have no further questions. I would like to hand it over to the management for closing comments.
Yeah, thank you everyone for joining this call. It's a pleasure and learning to be interacting with all of you, and we look forward to interacting with you again in post Q2 results. Thank you for joining.
On behalf of Alembic Pharmaceuticals Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.